We approach investing really from a long-term viewpoint. I mean, we are a very long-term investor. We have a time horizon that's can be 60 to 70 years. Again, we may be collecting contributions from a member who's 25, and we may end up paying them pension benefits until they're 95. So we have a very long-term time horizon. And so that's the context in which we look at things from. And we also spend a lot of time focusing on the risks that could cause us to not be able to meet the pension obligation. So in a plan like ours, there's really three major risks, which is risk of inflation, so wages will rise and we'll have to pay more money out. A decline in long-term interest rates, so if interest rates decline, it means it's going to be more difficult to invest those pension contributions we're receiving from members over the life of the plan, so it makes it more challenging. So that's a risk that's one of the biggest risks in the plan. And the other big risk that faces most plans is we invest money in stocks, and so at different points in time, stocks can go down a lot. So those are the three major risks in the plan. And so we've used what we describe as a liability-driven investment approach, which is trying the best as possible to minimize those risks and so that they don't impact our ability to meet the members' pension obligations. So the least risky position we can have as a fund is to own assets that have those same characteristics. They're inflation sensitive and interest rate sensitive. That way, if those factors cause the value of the liabilities to change, in other words, the value of the pension payments we have to make, the value of the assets will change with it. So in other words, they move together. And if you look at the way we structured our plan, essentially what we've done is we've given away some of the upside potential in order to eliminate that or reduce that downside risk. And so in markets where equities do extremely well, for example, very big up years, we won't do as well as our peer funds. We'll still do well, but we won't do as well as some of the other funds. But in down years, we're not going to lose anywhere near what they're going to lose, which I think is the right trade-off to make in a fund like ours, because it's going to keep you from having that big downside risk and getting on that slippery slope. And that's why it's always important to focus on the right metric. The annual return is not necessarily the best metric to focus on when you look at the success of a pension plan. What you should be focusing on is the funded status. That's the more important metric.